Hi everyone, and welcome to the Buffett and Beyond Research Stock of the Week, and we're going over O'Reilly Automotive, and they make automotive parts. And folks, this stock is up 11% while the market is down 11%. And yes, it's in one of our portfolios, and we use it as a good defensive stock. And remember folks, if you want to live on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And let's look at O'Reilly Automotive, and it supplies aftermarket auto parts, tools, equipment, and accessories to both do-it-yourself customers and professional mechanic or service technicians. Now, what this means, folks, is and why it's acting so good, and we're talking about on Thursday when the market was down almost 5%, this stock is up about, 1.62% for that particular day, is because types of auto part companies are considered defensive stocks. Because let's say we go into a recession or even the thought of a recession, then people say, I'm not going to go out and buy a new car. I'm not going to go out and buy a new house. I'm not going to buy new anything. I'll just wait another year and see how the economy does. And so what they do is they keep their old clunker that may be only 3 years old, and they keep that rather than buying a new car. And so if they need parts or they have to be repaired or just tuned up, then they go to a garage or auto mechanic who goes to O'Reilly and says, I need this part, I need that part. And guess what? O'Reilly delivers it that particular day, usually within an hour, because there's a local store close to every auto mechanic, at least in this country or most of this country. And then folks, the part is there and you get your car fixed and you wait till next year or when the economy gets better, or we know we're not going into recession, before you go out and you make that big ticket item. Now, it also offers services including used oil, battery recycling, and wiper bulb replacement. And as of December 2023, it operated 6,157 stores in 47 states, Mexico, and Puerto Rico. And it had 90,000 employees, including 14,688 part-timers. So let's take a general look at the stock, and we are looking at the average stock in our database, and the average stock holds true for the S&P 500, and that is in blue, and the green is O'Reilly. So we want to take a quick look like this at a chart exactly like this to see how this stock is performing relative to the average stock. Because remember, we want to fill our portfolio with above average stocks because we want somebody else to hold the below average stocks. And if we can outperform the S&P 500, then we're doing better than 96% of professional money managers over any 10-year period. Yes, let me repeat that. In any 10-year period, and this is a Morningstar report, in any 10-year period, they found out that 96% of professional money managers cannot outperform the S&P 500 on a 10-year rolling period. So the way that we outperform the S&P 500, in fact, over the past 22 years, 2.5 times to 1 on a compounded basis, the way we outperform is we pick the better than average stock, because any index, any mutual fund, any ETF has all the stocks, the above average stocks and the below average stocks. So we thought a long time ago, well, if we can pick the above average stocks, then we'll outperform any ETF, we'll outperform any index just about all the time. So that's why we look at this down and dirty chart. I shouldn't call it dirty, it's very, very convenient. And we see that O'Reilly, clean surplus return on equity down here. Clean surplus return on equity is a return on equity that compares the operating efficiency of one company to another company. And the clean surplus return on equity is so good that it allows us to compare O'Reilly with Meta, with Google. In other words, companies from different industries can be compared using the clean surplus return on equity, where the traditional accounting return on equity, totally different than the clean surplus return on equity, and traditional accounting return on equity cannot compare across industries. They can't even compare stocks. Why? Because the accounting profession configures the traditional accounting return on equity for an individual company, and they compare it year over year. They call that time series analysis, year over year for the same company. But we want to compare different companies so we can pick the best companies. Net income is the clean surplus income, and that is income that has to do only with the operation of the company. In other words, no non-recurring items or something that the company is not part of its core operating efficiency, like selling a piece of property if you're a car company, or if you're McDonald's and you're selling some of the property under some of the McDonald's and then leasing them back. Well, that's not what the company does. The company is a burger company, and we want to compare it to the burger companies. But the clean surplus net income and the clean surplus return on equity allows us to compare all companies together. And revenue, well, the average stock is bringing in revenue of 7.1%, and O'Reilly is bringing in revenues of 15%. In other words, twice as high or a little bit more than twice as much as the average stock out there. So you can see the green lines are all ahead of the average stock out there. So right away, we can consider O'Reilly for our portfolio. It doesn't mean that it's going to be in it. It means that we consider it. Now, when we look at the clean surplus return on equity, we really like to see a company that has a 20% or higher return on equity, like O'Reilly once did. But we can see that over the years, it has been coming down just a little bit, the return on equity I'm talking about, coming down just a little bit. So we have to be very, very careful here. But you're going to see why it's still in our portfolio, even though the ROE fell below 20%. And when we look over here at net income, we can see that this net income, well, we can't see that it has been reduced by about $1 for 2024 and $1 projected for 2025, less than had been originally projected. And we'll see that on the chart in a minute. But so this ROE is going down a little bit. But other things we like about this company, one, it's defensive. We're going to really see that in a second. Retention rate, 100%. That means all the money it's making, putting it back into itself in order to grow. Nice. And then we already looked at the net income and revenue growth. Let's go over here to years to pay debt. With the net income and revenue growth both above average, the average stock, whether it be the 5-year average or the 1 year going into 2025, both above the average stock. Years to pay debt, this is Buffett's rule of thumb. He says if a company takes all the money that it's making and puts it back into itself in order to pay off its debt, how many years would it take? His rule of thumb is 5 years or less. Our rule of thumb is 3 years or less. So this company can pay off all its debt in 2 years. Very, very nice. And of course, it's not paying out a dividend because it's taken all the money it's making and putting it back into itself or retaining it in order to grow. That we like. Now, let's look at the past 12 months. And remember when I told you that those 2024 and 2025 numbers were reduced by $1? This is what happened to that stock. When that announcement came out, the stock went down. Black line is the S&P 500. It went down below the S&P 500, but since then has been coming back nicely. Then all of a sudden, as the market started going down, O'Reilly started going up, and we can see now O'Reilly for the last 12 months up over 26-27%, while the market itself, the S&P 500, is up about 4% over the past 12 months. So the market itself is not doing that well over the past 12 months, most of it because of this decline in here, and also about 6 or 7 months ago we had another decline in here that took some of the steam out of the market. So this is where we are right now, folks. We're playing with this line down here because we had a tough Thursday after the announcements of the tariffs came out. Now, let's look over the past 5 years. Black line S&P 500. Look at O'Reilly. Now, this is 2022. The market was down 19.6%, and I'm talking about the S&P. The NASDAQ was down 34%. What did O'Reilly do? Well, it started out the year here, and it ended up the year up here. So you can see how this is a defensive stock, and now you see why we will allow it clean surplus ROE a little below 20% because it's such a good defensive stock. And folks, you can't beat this as a growth stock. And when we look at the S&P over the past 5 years, it's up about 120%. and O'Reilly is up about 380%. So we're looking at more than tripling the S&P 500 for a defensive stock that saves you this type of pain when the market goes down, this stock goes up. Look over here. The market's going down and this stock is going up. And this is just happening, what, in the past 3 weeks or so? Yeah, market's going down ugly. And when we look at another chart, this is a candlestick chart, we can see this is just O'Reilly, and this is Thursday. So it's up about 1.2%. So this travel in here on this line from here to here, 1.62%. And what is the S&P down? Close to 5%. So it would be down around here, actually about 4.5%. It would be down around here. So the market on this particular day, which is Thursday, this stock is up 1.62%, while the market is down about 4.5%, which would bring the market down here. The S&P would have fallen from here down to here, while O'Reilly is started here and went up to here. So folks, we have a good stock here, and we like the defensiveness of it. And yes, it's in our growth portfolio. And after a day like Thursday, we sure wish we had all our stocks like O'Reilly in our growth portfolio. So folks, we had a tough week this week. We thought the market was going to bottom out on Wednesday and head for a little rally in there, and it did not. It turned around. The market did not like what it heard about the tariffs, and the market went down. O'Reilly went up, but the market went down. So folks, tough week. Go out, clear your heads. You have a good time. Be with your family. Go walk by yourself and forget about the market, because it'll be back here soon enough. And folks, we'll see you right back here in a couple of days.